The Creature from Jekyll Island, A Second Look at the Federal Reserve, is a book that explores the creation and inner workings of the Federal Reserve System in the United States. Written by G. Edward Griffin, the book delves into the history of the Federal Reserve, its origins, and its impact on the American economy. Here are 12 key takeaways from the book. 1. The Federal Reserve System is a cartel. The Federal Reserve System is a cartel of private banks that work together to control the American economy. This system was created in secret by a group of bankers and politicians who met on Jekyll Island in 1910. These individuals were seeking a way to gain control over the nation's money supply and to protect their own interests. Today, the Federal Reserve is composed of 12 regional banks, which are owned by the private banks in their respective regions. The Federal Reserve is not a government agency and operates independently of the government. Example: in 2016, Senator Bernie Sanders cited The Creature from Jekyll Island during his presidential campaign as evidence of the need for greater regulation of the financial industry. 2. The Federal Reserve has the power to create money. One of the most significant powers held by the Federal Reserve is the ability to create money. The Federal Reserve can create money out of thin air by simply adding numbers to bank accounts. This power is known as monetary policy and allows the Federal Reserve to control the money supply and influence interest rates. The Federal Reserve can also influence the economy by buying and selling government securities. Example: in 2020, the Federal Reserve used its power to create money to inject trillions of dollars into the economy in response to the COVID-19 pandemic. 3. The Federal Reserve's policies can lead to inflation. The Federal Reserve's policies can lead to inflation, which is a rise in the general level of prices in the economy. When the Federal Reserve creates too much money, it can lead to an oversupply of money in the economy, which can reduce the value of the currency and lead to higher prices. Inflation can have negative consequences, such as eroding the value of savings and reducing purchasing power. Example: in the 1970s, the Federal Reserve's policies contributed to high levels of inflation in the United States, which had negative economic consequences. 4. The Federal Reserve's policies can affect employment. The Federal Reserve's policies can have a significant impact on employment levels in the United States. When the Federal Reserve lowers interest rates, it can encourage borrowing and investment, which can lead to economic growth and job creation. However, when the Federal Reserve raises interest rates, it can have the opposite effect, leading to decreased borrowing and investment, and potentially to job losses. 5. The Federal Reserve's decisions are not always based on economic data. The Federal Reserve's decisions are not always based on economic data. Instead, the Federal Reserve often makes decisions based on political considerations or the interests of the banking industry. This can lead to decisions that do not align with the needs of the American people or the broader economy. Example: in the aftermath of the 2008 financial crisis, the Federal Reserve bailed out large banks and corporations with taxpayer dollars, despite concerns that this would not benefit the broader economy. 6. The Federal Reserve's policies can favor Wall Street over Main Street. The Federal Reserve's policies can often favor Wall Street over Main Street. This is because the Federal Reserve's policies can benefit large banks and corporations, which are often located in financial centers like New York City, at the expense of smaller businesses and individuals in other parts of the country. This can lead to greater income inequality and concentration of wealth in the hands of a few. Example: in 2020, the Federal Reserve's policies were criticized for favoring large corporations and wealthy individuals over small businesses and lower-income Americans during the COVID-19 pandemic. 7. The Federal Reserve System has a history of creating crises. The Federal Reserve System has a history of creating crises through its policies. For example, the Great Depression was in part caused by the Federal Reserve's monetary policy, which contributed to a severe contraction in the money supply. Similarly, the housing bubble and subsequent financial crisis of 2008 were partially caused by the Federal Reserve's low interest rate policies, which encouraged risky lending practices and inflated asset prices. Example: in 2020, some economists argued that the Federal Reserve's low interest rate policies could lead to another financial crisis in the future, as they encourage investors to take on more risk and inflate asset prices. 8. The Federal Reserve's policies can create financial bubbles. The Federal Reserve's policies can create financial bubbles, which are periods of rapid asset price growth followed by sudden crashes. These bubbles can have significant economic consequences, as they can lead to widespread financial instability and economic disruption. The Federal Reserve's low interest rate policies have been blamed for creating bubbles in various asset classes, including housing, stocks, and cryptocurrencies. Example: in 2021, some economists argued that the Federal Reserve's low interest rate policies were contributing to a bubble in the stock market, as prices continued to rise despite concerns about overvaluation and potential risks. 9. The Federal Reserve's independence can be a double-edged sword. The Federal Reserve's independence can be a double-edged sword. On the one hand, the Federal Reserve's independence allows it to make decisions based on economic data and not be subject to political pressures. On the other hand, the Federal Reserve's independence means that it is not accountable to the American people, and its decisions may not always align with the needs of the broader economy. Example: in 2020, some lawmakers criticized the Federal Reserve for its lack of transparency and accountability in its decision-making process, particularly with regard to its emergency lending programs during the COVID-19 pandemic. 10. The Federal Reserve's policies can have global consequences. The Federal Reserve's policies can have global consequences, as the US dollar is the world's dominant currency and the Federal Reserve's policies can influence global financial markets. The Federal Reserve's decisions can impact exchange rates, trade flows, and capital flows, and can have significant economic and geopolitical implications. Example: in 2013, the Federal Reserve's decision to begin tapering its quantitative easing program led to a sharp increase in interest rates and capital outflows from emerging markets, causing significant economic disruption in many developing countries. 11. The Federal Reserve's power has expanded over time. The Federal Reserve's power has expanded over time, as its role in the American economy has become more significant. The Federal Reserve now has a range of policy tools at its disposal, including the ability to create money, set interest rates, and engage in various lending and liquidity facilities. As the Federal Reserve's power has expanded, so too has the potential for its policies to impact the broader economy. Example: in 2020, the Federal Reserve's emergency lending programs played a significant role in supporting the American economy during the COVID-19 pandemic, demonstrating the expanded power of the institution. 12. Alternative monetary systems have been proposed. Alternative monetary systems have been proposed as alternatives to the Federal Reserve System. These systems include the gold standard, which would tie the value of the US dollar to gold, and various forms of digital currencies, which could potentially offer a more decentralized and transparent system of money creation and distribution. Example: in 2021, the rise of cryptocurrencies like Bitcoin and the growing interest in central bank digital currencies has renewed debates about the future of money and the role of the Federal Reserve System in the American economy. In conclusion, The Creature from Jekyll Island, A Second Look at the Federal Reserve, is a thought-provoking book that challenges many commonly held beliefs about the Federal Reserve and its role in the American economy. It raises important questions about the nature of central banking and the need for greater transparency and accountability in our financial system. While not without its controversies and criticisms, the book has inspired many individuals and organizations to question the status quo and to advocate for meaningful reform. We want to take a moment to say thank you for your support of our YouTube channel. Your engagement and feedback mean the world to us and motivate us to keep creating great content. Let us know what book we should do next. Don't forget to like, comment, and subscribe, and check out our other videos for more summaries of the latest and greatest books.